I'm Cesar Delgado from Back Roads of Illinois. I am joining with John Payne out of Chicago with Hedge Global. Welcome to join us for today. How are you? Nice to meet you.
Hi, Seth. Hi, Caesar. How you doing? This pleasure to be speaking with you. I am um, doing very well. I do a fair amount of media, and this one is certainly one of the most exciting. Not just because you're an Illinois fan, but because you're from close to where I'm from in Moline, Illinois.
John, tell us what's going on with corn and soybeans in Brazil and Mato Grosso. Could you tell us about this topic from your analysis for your firm?
Sure. Let me first say that I work for a company called HedgePoint Global Markets in Chicago. We're a firm that has been around a long time from the standpoint of who we came from. We're from a spin of an older bank called EDF Man. EDF Man was a bank that traded sugar and all sorts of different types of commodities out of London. And they made some mistakes with their sugar markets, and they ended up having to spin off the Brazilian assets, which is who owns the company I work for, HedgePoint. So I come to you from the perspective of a Brazilian to a degree. I live in the United States. I live in Chicago, but the majority of the clients that work with HedgePoint Global are from Brazil, whether that be soybeans, coffee, cotton, corn, all the commodities that are grown there, except cattle. For some reason, cattle isn't one of those markets that's trades, but in Brazil. But anyway, getting to your question, talking about Brazil and Mato Grosso, basically we are seeing the crop in Mato Grosso as average to below average. So nothing in the terms of crop failure. And I think that's important to note here because the Brazilians that we work with sell the Chicago Board of Trade. So if you're farming in Mato Grosso and you're a producer who's going to grow soybeans there, you will sell the board here in Chicago if you want to put a hedge on forward for what you're going to grow. And a lot of producers are doing that now. So what they're doing is selling soybeans ahead. And what that does is create two things. One, it creates a pretty decent sized short position on the board. And then two, it creates a reason that we would buy those bushels back if the production isn't there. So this is a long way of answering your question is these producers are not buying back any production that would make the market go higher because the crop is satisfactory. It's not the best crop they've ever had, but it's the most acres they've ever had. So we see supplies as ample in Brazil, and what is missing from Brazil will be made up in Argentina. As we saw today, Argentina was selling soybeans to Brazil, and vice versa, rather. Buying beans from Brazil. So all in all, there's a lot going on there in South America that isn't bullish for the Chicago markets.
How about in Parna?
Parna's been a little worse. So
How do you see impacting the export to China from Brazil because of the weather situation?
well, at this point, China is going to be buying Brazilian beans against the U.S. for two reasons. One, they don't like the U.S. on the margins, meaning they'd rather trade with the Brazilians than trade with the U.S. just to throw kind of a dart into the trade war that's been going on, going back to when Trump kind of got things started in 2018. Our imports from China are lower from 2018, whereas they're higher from Mexico and Canada. So China's losing market share to the United States. That's going to create a need for them to buy Brazilian beans over the U.S. The second is going to be the Chinese crushing margins. So crushing margins in China aren't great either. So it's not just that they don't want to buy U.S. beans; it's that they don't want to buy beans at all. So until we would see the U.S. the crushing situation in China improve, I'm very difficult to see markets rallying. Now, I will say, Caesar, Like everything I'm saying is known. So I probably sound a little bearish here, and I am bearish, but that doesn't mean that the market can't change on a dime. And I'm a very good indicator to fade because I do follow the news quite a bit. So something to keep in mind for folks who are listening out there.
Yeah, it does not guarantee. It's close Bell in downtown Chicago.
Well, negative. Everything on the grain side has been negative. It's been a really nasty start to the year. It was a nasty fourth quarter. We've really seen supply markets come down globally, not just in the United States. We've had export markets have left our shores and gone to Brazil. That story continues today. We have weak markets in the edible oil sector. So not just soybean oil, which soybean oil kind of trades with diesel oil right now to a degree, which has kind of kept the stronger complex. But on the edible oil side, so like when you go to your grocery store and you're buying things with soybean oil in it, those are all getting cheaper. Edible oils like canola.
How are the cattle markets?
Okay, so let's start with cattle. Okay. Cattle markets have been on fire. They were down a little bit today, but I'm speaking to you on a Tuesday I'm sorry, on a Wednesday as you listen to this, the 7th of February. So cattle's pulled back a little bit, but we had a really surge higher yesterday. Really mainly based off of Packer margins kind of coming into the green here. So we had Tyson earnings come out on Monday, and while they still talk about the problems in the cattle market, they did point towards lower costs. They've reined some costs under control, which I think saw the market say, hey, maybe they can afford to bid up on the live side here a little bit. So yesterday the live rallied, and we've seen feeders obviously rally. That's based off supply. Sure, you've talked about the crop report, the cattle report that we got a week ago. But the feeder markets in general will rally here, especially if the weather will stay strong out west. And right now they're still dealing with drought. So these guys, the one thing that could really wreck the market would be if you'd have some sort of reason for these guys to liquidate out in the pasture and take them to town. And at this point, producers don't have the intention of doing that. I don't think that's priced in yet. But at this point, it's certainly strong, especially the back end of the curve.
How about the lean hog?
So lean hogs is something I've been working on. I've been working in the lean hog markets really since my start. So it's kind of my favorite market to trade. It's got a lot of volatility. Lean hogs have done very well the last, we'll call it since the first of the year. We've probably seen 10 or 20% rally in some markets, 15% in others. The front of the curve mostly has moved higher on a cutout. So, Caesar, beef prices and pork prices this is what's leading the market. It's not so much the live animal fundamentals right now, in my opinion. I think it's the meats, especially in pork. I attended a conference a couple of months. Can't give advice, but let's say you were a producer. Okay. And this isn't for everybody, but a producer might want to go look at like insuring price up here. So insurance on price, almost like you're buying car insurance. So you put out a fix a premium and it puts a floor under the price markets through the fall of next year. That makes sense to me. What would be difficult to swallow is if the market goes above 300 and we catch a huge spike up. Can you handle that? If you can handle that, you can do some call selling. You can do some more aggressive positions on the board, but you have to be very careful here. If there's one thing I've learned over the last year in feeder cattle, just watching the trade, leverage can kill you because the market, post-October market, we went from, we'll call it 260 in the August contract, and we've essentially broke everybody who was long and came right back to that price. So it creates it creates a tremendous amount of pain in the market if you can't afford it. So the key is to trade with leverage in mind. That would be my biggest advice to your listeners, Caesar, is leverage is the biggest, it's your biggest friend and your biggest enemy. You have to be very careful of margin and all of the things that come along with that.
I agree with you, especially the commodity.
From Brown Burlington. not too far probably from where you are. And he said to me, he goes, "Oh, you're gonna lose your shirt," when I told him that. So at this point, I've learned a lot, and I've learned that I don't know where it's going. That certainly is the case. It's almost like betting on two jumping, mosquitoes to a degree. They just kind of do what they do, and I think you can guess long-term trends and be a little more accurate doing that. But at this point, for folks who are listening to you in Illinois, they have a tremendous amount of endowment, and by that meaning, as the market goes up, they appreciate, their values of life can appreciate, and when the market goes down, vice versa. They could see their land costs go down, and makes business harder to do. To come out of that, to eliminate that kind of risk, that is what the board is for. So to get to neutral, where I'm not a producer of either commodity. I consume it, but not really on the margins that would make me want to invest ahead. Producers need to be careful here. I've heard, just coming across our desk, we work with a lot of elevators. So people who sell physical grain to the elevator would work. You might work with us and not even really know it. We're the ones who are kind of offering the risk to the elevator. And I'm hearing some strategies that are being put on of very aggressive short trades in the corn markets that would concern me a little bit from the standpoint of that leverage. If this thing would turn for whatever reason, and Caesar, like I said, if I knew, I wouldn't be talking to you. I'd be on a beach somewhere, So my point being is that is not baked in the cake yet.
That's true, John. Do you have final thoughts on Brazilian production in poor quality and the yields?
Well, I'll leave you with this for Brazil. And I hope you have me back on again because I love to talk about Brazil. I have conference calls every morning with people in Brazil who can kind of keep me boots on the ground, what's going on. The Brazilian crop is not perfect. It's not perfect by any means. They had that rough, dry patch. But right now, it is not a disaster. It's maybe a subtrend yield to a degree. And right now, I would say from what I've heard, the crop may be, the disaster is already factored in. They could be at 170 million metric tons for soybeans. Right now, they're at 150, we'll call it, which is drastically lower. But Caesar, if we were talking 5 years ago, Brazil was barely growing 100. So the question for me going forward, I'm a Midwestern kid. You're a Midwestern kid. You live in the Midwest here in the U.S. around all this farmland. It's how does the U.S. compete going forward with a cost of production in Brazil is lower. They don't have the same amount of structure, and they're already set up. Whereas our farmers are small. They're smaller to a degree, and consolidation is going to be easier to happen here.
We will see on this planting season in central Illinois and across the Midwest, but we have a great food supply.
We do. We have a great food supply right now. We have, stocks high to a degree. Demand is slacking. And these are all things that should help the consumer. Like anybody who's using grain, you should be doing okay. The question big for and going forward is going to be in soybeans. And what does the liquid fuels market look like in 5 to 10 years? Because if it looks like it could, where we're putting soybean diesel in jet planes, there's a lot of upside here. But in the short run, we don't have the capacity to, operate at these crush margins and have growth in price. We need to see the product market steady out here. So watch soybean meal, watch soybean oil. Those are two big indicators here. Soybean oil specifically. If soybean oil falls apart here, that's a scary thing for me, where we could go back down into the 30-cent range for soybean oil, which is, a little bit higher than where we traded pre-COVID.
Thanks for coming along with us, John. My pleasure that you joined the show for today. Thanks.
Thanks for having me.
To join the show anytime.
Yeah, I look forward to doing
John
it, and
Payne,
let's keep doing it.
Hedge Global in Chicago from back roads of Illinois. I am Cesar Delgado. Have a good day.